Be fearful when others are greedy, and greedy only when others are fearful. These are not the words of a doomsayer predicting a crash, but the legendary advice from Warren Buffett, one of the most successful investors in human history. And right now, as the FTSE 100 index smashes through all-time record highs and the champagne corks are popping across the city of London, these words should be ringing like an alarm bell in your head. It's easy to get swept up in the euphoria. Your portfolio is likely looking healthier than ever. The headlines are screaming about a new bull run. But according to Buffett, this widespread celebration, this collective greed, is precisely the moment for maximum caution. This feeling of greed is driven by one of the most powerful and destructive emotions in finance, the fear of missing out, or FOMO. It's a primal instinct. Our ancestors survived by sticking with the tribe. Being left behind meant danger. In modern markets, this instinct gets twisted. We see others getting rich, and our brain screams at us to join the herd before it's too late, causing us to buy assets at their most expensive, most dangerous point. So what does this really mean? Are we supposed to sell everything and run for the hills? Absolutely not. Today, we're going to dissect Buffett's most famous piece of advice and show you how to apply it in the real world. We will uncover why a soaring market can be a dangerous trap for the average investor. Then, I'm going to reveal the story of a FTSE 100 giant, a household name whose stock has been crushed, falling by a staggering 32% while the rest of the market parties. And most importantly, we'll explore why this exact moment of crisis for this company could represent one of the greatest buying opportunities in today's expensive market. This is a deep dive into the art of thinking differently and profiting from pessimism. To truly understand this philosophy, you have to understand Buffett's concept of Mr. Market. Imagine the stock market isn't a cold, impersonal entity, but a business partner you have named Mr. Market. The problem is, Mr. Market is a manic depressive. Some days, he shows up at your door euphoric, screaming about how wonderful the future is. On these days, he'll offer to buy your shares from you at ridiculously high prices, or sell you his shares at equally inflated prices. This is the greedy phase. This is the FTSE 100 at an all-time high. Then, on other days, Mr. Market shows up despondent and terrified. He's convinced the world is ending and that business is doomed. On these days, he'll offer to sell you his shares for pennies on the dollar, desperate to get out at any price. This is the fearful phase. Buffett's genius was realizing that you, the intelligent investor, are not obligated to trade with Mr. Market every day. You can ignore his wild mood swings. Your job is to use his emotional instability to your advantage. You politely decline his manic, overpriced offers, and you eagerly accept his panicked bargain basement deals. We've seen this play out time and time again. Think back to late 1999, during the dot-com bubble. Mr. Market was euphoric, convinced that any company with a .com in its name was destined for greatness, even if it had no profits or even a coherent business plan. He was offering to sell you shares in pet food websites for more than the value of established industrial giants. A few years later, after the crash, he was despondent, practically giving away shares in solid, profitable companies because he was convinced technology was a fad and that no one would ever make money online again. The intelligent investor ignored him in 1999 and went shopping in 2002. The current market, hitting new records, is Mr. Market in a state of pure euphoria. He's the life of the party, telling everyone the good times will never end. This is when the danger of emotional contagion is highest. That FOMO kicks in. You see others making money, and you feel an overwhelming urge to jump in with both feet, regardless of the price. That is how bubbles are formed and how fortunes are lost. Buffett's advice to be fearful is a call for emotional discipline. It means you must step back from the cheering crowd and do your own homework. It means remembering that the price you pay for an asset is critical. Just because a company is good doesn't mean its stock is a good buy at any price. The goal is to buy wonderful companies, but only when they are on sale at attractive valuations. And here's the secret. Even when the overall market index is at a record high, there are always individual companies, individual sectors that Mr. Market has thrown into the bargain bin out of fear or neglect. That is where the real work and the real opportunity begins. So let's get specific. How do we find one of these fearful opportunities amidst today's greed? Let's look at Diageo. That's Diageo. Even if you don't know the corporate name, you absolutely know their products. We're talking about a global beverage behemoth, the owner of Guinness, Johnnie Walker, Smirnoff, Captain Morgan, Tanqueray, and Baileys. They even have a stake in the Moet Hennessy Champagne House. You would think that with the FTSE 100 hitting new highs, the executive team at Diageo would be leading the celebrations. You would be dead wrong. In fact, the mood at Diageo headquarters is likely funeral. It was just announced that their chief executive is leaving the company after a relatively brief and difficult tenure. Under her leadership, the Diageo share price has fallen off a cliff. The problems run deep and have spooked investors. Their crucial Latin American and Caribbean market, once a star performer and a major engine of growth, has seen a dramatic and painful slowdown. Consumers there, squeezed by high inflation and economic uncertainty, are trading down from the premium spirits that are Diageo's bread and butter. In North America, the post-pandemic party has clearly ended, and the explosive growth in sales of high-end tequila and whiskey has stalled, returning to more muted, normal levels. This isn't just a minor blip, it's a fundamental challenge to their recent growth story. Think about this contrast for a moment. The index of leading UK companies is at its peak, yet this blue-chip giant within that very index has seen its value plummet. Over the past 5 years, the stock is down an incredible 32%. 32%! Billions and billions in shareholder value have simply evaporated. Clearly, Mr. Market is deeply, deeply fearful about Diageo. He's looking at weak demand for premium spirits, seeing a leadership team in turmoil, and he is panicking. This is a story of fear and crisis. It sounds like a complete disaster, doesn't it? A company you should run a mile from. But what if this widespread fear is the exact signal that a true value investor has been waiting for? If you're finding this counterintuitive strategy compelling, do me a favor and hit that like button. It shows me you're interested in digging deeper than the headlines, which is exactly what we're about to do. Now, let's flip the script. While others are fearful, this is where we start to get greedy. Not recklessly greedy, but intelligently greedy, based on facts, not feelings. The first thing Buffett would look for is a durable competitive advantage, what he famously calls a moat. Does Diageo have one? Absolutely. Its moat is built from its portfolio of iconic, world-famous brands. These aren't just products, they are cultural institutions. Take Guinness. It's more than a beer. It's a symbol of Ireland, a pilgrimage for tourists to the storehouse in Dublin, a brand with a unique mystique built over 250 years of history. Or consider Johnnie Walker. From the most exclusive boardrooms in Tokyo to lavish weddings in Mumbai, that striding man logo is an internationally recognized symbol of success and aspiration. You cannot create this kind of global heritage, this deep-seated psychological connection with consumers overnight. It takes centuries and billions in marketing. This is what a real defensible moat looks like. This brand power gives Diageo something incredibly valuable: pricing power. In an inflationary world, the ability to raise prices without destroying demand is the holy grail of business. These brands have been around for generations and will likely be around for generations more, giving the business a long-term stability that is hard to replicate. Let's not forget, Warren Buffett himself invested in Diageo's predecessor company decades ago because he recognized this very strength. Second, let's look at the financials, not the stock price. Despite the turmoil, Diageo remains massively profitable. This isn't some speculative company bleeding cash. This is a cash-generating machine. The fear is about future growth, not current survival. This profitability allows them to do something remarkable, something that puts them in a very exclusive club on the FTSE 100. For decades, through recessions, market crashes, and global crises, Diageo has managed to increase its dividend payment to shareholders every single year. Think about that for a second. Through the dot-com crash of 2000, the global financial crisis of 2008, the Eurozone debt crisis,
Brexit, and even a global pandemic that shut down bars and restaurants worldwide, Diageo kept sending bigger checks to its owners. That isn't just a financial metric, it's a testament to the sheer resilience and cash-generating power of the underlying business.
It's the kind of reliability that Buffett refers to when he says he wouldn't trade a second of good sleep for extra profits. While the stock price is volatile, that dividend check has been a reliable, growing source of income for investors. Finally, let's talk about price. The fear surrounding Diageo has made its valuation much more reasonable. It's currently trading at around 16 times its annual earnings. Now, to be clear, that is not a screaming bargain.
This is not a stock in the deep discount aisle, but for a business of this quality, with this brand portfolio, and this history of profitability, a price of 16 times earnings is what many would consider a very attractive price. We are getting the chance to buy a wonderful company at a fair price, which is the core of the Buffett-monger philosophy. Of course, we cannot ignore the very real risks. This is not a guaranteed home run.
Being a contrarian investor means you have to stare the problems directly in the face. The biggest long-term threat is a cultural shift. Younger generations, particularly in Western markets, are drinking less alcohol than their parents and grandparents. This could signal a long-term, structural decline for the entire industry, similar to what we have seen in the tobacco industry for the last half-century. This is a serious headwind that cannot be dismissed.
This isn't just about people drinking less, but drinking differently. The rise of craft cocktails, premiumization, the trend of drinking less volume but better quality, and the sober curious movement are all reshaping the landscape. The key question for Diageo is whether they can adapt. Can their innovation pipeline, which includes non-alcoholic versions of their famous brands like Guinness 0.0 and Tanqueray 0.0, successfully capture this new and growing market? Their success or failure here will be a critical part of their future story. Furthermore, the weak demand in key international markets is a current, ongoing problem that is hurting revenues right now. And the departure of the chief executive creates a vacuum and uncertainty at the top. The next leader will have a monumental task to turn the ship around. But let's be honest about the psychological challenge here. Buying a stock like this is difficult. Your friends will be talking about the tech stocks that are flying high. Financial news channels will be filled with bearish commentators on Diageo.
You will feel a constant nagging self-doubt, wondering if you're the smart one or the sucker. This is the price of admission for contrarian investing. It requires a conviction rooted in your own research, not in popular opinion. You have to trust your analysis of the business's long-term value over the market's short-term mood swings. Here is the crucial point. All of this bad news, all of these fears are already known. They are the reason the stock is down 32%. Mr. Market has already priced in a significant amount of pessimism. The investment thesis here is not that these problems don't exist. The thesis is that the fear surrounding these problems has been exaggerated, pushing the price of this high-quality, cash-rich company down to an attractive level. This is the essence of contrarian investing. It's about weighing the tangible, long-term strengths of a business, its brands, its profitability, its dividend history, against the more ephemeral, sentiment-driven fears of the market. It requires patience, research, and the emotional fortitude to buy when everyone else is selling. If you want more deep dives like this, breaking down the psychology of the market and uncovering opportunities that others are too scared to touch, make sure you subscribe to the channel and ring that notification bell so you never miss an update. So, as you see the headlines celebrating new market highs, take a moment to remember Warren Buffett's advice. The biggest profits are rarely found by following the cheering crowd. They are often found in the quiet corners of the market, in the companies that have been abandoned and left for dead. The real question is, do you have the courage and the discipline to be greedy when everyone else is